Hello, and welcome to another economic and industry update brought to you by Greenbrier's marketing team. I'm Mallory Moran, and I'm joined by Jay Carter. So let's start with the overall economy. Jay, what are you seeing?
Thanks for having me, Mallory. The second quarter showed solid growth that exceeded expectations. GDP rose 2.8%, driven by higher consumer, inventory, and business spending. Now, the employment news wasn't positive as the Labor Department reported only 114,000 new jobs created in July, which is significantly less than June. And this ultimately contributed to the uptick in the unemployment rate, which rose to 4.3%.
What about inflation?
On the inflation front, the numbers have been trending more positive as the personal consumption index slowed to 2.5% for the 12 months ending in June, which is down from the 2.6% the month prior. The closer that number gets to the 2% target, the more likely the Fed is to cut interest rates. If these conditions continue, coupled with a weaker labor market, I think we could see rate cuts sooner than later.
The next quarter will be an interesting one for sure. Now let's take a look at the rail industry. Recently, the industry reported second quarter railcar orders, deliveries, and backlog. The total railcar orders were up significantly to about 9,600 units, up from under 6,000 last quarter. Deliveries were down a bit to about 10,000, and the backlog decreased slightly, nearing 45,000 railcars. Jay, help us put this into context.
Well, Mallory, orders going up sequentially, but still below what the industry is producing, which shrinks backlogs. So that's not good. Regarding carloads, although the total carload number was down in the second quarter, it's largely due to a decrease in double-digit coal carloads, an area which Greenbrier isn't active. When you exclude coal, carloads were actually up 1.7% in the second quarter. This was largely driven by intermodal, which was up 8.2% in the second quarter, the highest volume since Q2 of 2022. Weak carload outlook and elevated new railcar prices constrain the delivery forecast. Now, regarding cars in storage, as of August 1st, 19.7% of the North American fleet was in storage, and this is well below the historical average. The real surplus of percentage of rail cars in storage is actually lower than 19.7% reported, and this is due to chronically idled rail car types. Storage numbers were particularly low for covered hoppers, tank cars, and vehicular flat cars. This indicates solid shipments for commodities such as grain, ethanol, crude oil, and motor vehicles.
Any final thoughts?
Sure, Mallory. Until the Fed takes action, this prolonged period of high interest rates is going to weigh on rail demand. I'm also keeping an eye on price volatility caused by potential Chinese tariffs. With uncertainty in the election cycle, along with deliveries being greater than orders, we remain cautiously optimistic about new railcar demand as replacement demand drives new orders in the near term. I expect lower orders with steady deliveries through the forecast period. Thanks.
Thanks, Jay, and thank you for watching. We hope you found this video informative. Be sure to tune in next quarter for another update from Greenbrier's marketing team.